My name's Dorian. I'm the Chief Executive at Belvoir Group PLC. I'm also here. She's not on video just yet, but my co-director Louise George will be joining very shortly to really sort of pitch in with the questions. So please ask away towards the end of the presentation. Okay, so we've got a fairly short presentation. We think sort of 15 to 20 minutes max. Introduction to myself, 24 years in the property sector and 17 years with Belvoir, and Louise, 20 years as a board member on AIM-listed businesses, and eight actually very successful years with Belvoir. When I sort of think back to what the business looked like 8 years ago, I was obviously around 8 years ago. We were trading just as one brand, as Belvoir Lettings, as a sort of letting specialist, residential letting specialist, looking after properties on behalf of landlords. And as you'll see as the slide deck unfolds, we're now a very different business. We're property, mortgage, estate agency. We cover a sort of broad range of property services, and the real key is that we are a franchise business, which I'll sort of explain through the slide deck. I'd also like to point out just a couple of things before we move off this slide. So Louise and I both have shares in the business, and at an event a week or so ago, an investor asked me, you know, it looks as if on our sort of register that directors have been selling rather than buying. We didn't have a chance to answer that question, so just in case the same person is here this evening, I just wanted to say that Louise and I have both increased our holding over the last 12 months. What Louise has been doing is, bear in mind we didn't have founder wealth, so Louise has been sort of, when she's been awarded share options, generally she's been selling enough shares to cover the tax element, and then she's been retaining all of the sort of net gain. Because I'm much longer in the tooth, I've been around for 17 years at Belvoir. I haven't sold shares sort of outside of sort of share options. I've been doing the same as Louise, but I've taken some cash out when I've had share options materialise. But I've also been keeping shares at the same time. I sort of split my net gain between half cash and half additional shares. But just to be clear, we've both increased our holding over the last 12 months. Okay. If you can pass me on, Louise, please. Also, if you would like any further information after the presentation, we do have a separate website that contains investor information. It's called belvoirgroup.com. We've also got a very short 3-minute corporate video on there if you want to sort of recap of what we do, what our values are, and what our strategy is. There's a short video. It's right in the middle of the home page when you log into belvoirgroup.com, and our latest annual report is also on there. It was released at the same time as our full year results, which were released on the 4th of April. So we just recently sort of completed a round of investor, institution and retail investor meetings. So you know, what are we and what do we consist of? Well, we are a property franchise and financial services group. I'll whisk through a few of the headlines. I've got two screens if you wonder why I'm looking sort of in two directions. So revenue, first of all, this is full year 2021. Our year ended in December. We reported to the market on the 4th of April. So revenue 29.6 million, and hopefully you can see on the chart there, you can see revenue growth since 2017. Profit before tax up to 9.3 million, which is 39% up on the previous year. And again, little chart there with the grey bars just showing the growth in profit before tax. In case you can't see it, 2017 it was 3.9 million, and that's now grown to 9.3 million. Share price, as of year end 262, it's actually fallen back slightly, which may represent value if anybody's thinking of buying shares. But share price 262, and again on the graph there you can see the growth in the share price since 2017. It was 99p in 2017, and dividend 8.5 pence per share. That's an 18% increase on the previous year. We've always paid a dividend. We've never missed a beat with our dividends since we listed in 2012. We did suspend the dividend that was due sort of March, April 2020 for COVID reasons, but we reinstated that dividend later in the year. So we didn't miss a dividend as such. So our dividend's always been rock solid, never missed a beat. And if you do have a look at the FinCap research note, which is free and it's available to all of you, in FinCap's numbers, it does show a commitment to a progressive dividend policy going forward. So our ticker is BLV. We incorporated in 1995. We floated, as I said, in 2012 at a market cap of around 16 million. It was a touch less than that, and at a share price of 75p. The market cap is around 100 million, give or take. We've had an incredible 25 years of unbroken profit growth. You know, we had a good year last year, partially because of government intervention, so stamp duty holiday, lots of activity in the property sector, but please bear in mind that, you know, we've had 25 good years of unbroken profit growth. It wasn't just a particularly good year last year. We generally have a good year every year. We've got a history of reliable dividends, as you can see, and the new excuse me, FinCap target price is 371p. And there's a note on the screen of where you can get that research from. We have 3 weeks ago said to the market that we are in line with expectations so far this year, so we've had a decent start to the year as well. Okay, so what do we do and what do we trade as? Well, in the middle of the screen there, you'll see a number of property brands. So we have around 360 physical high street lettings, sales, estate agency mortgages, offices based around the country, trading as Belvoir, Newton Fallowell, Northwood, Lavelle, Humphreys, which is a business that we bought last year, and we also dual brand premises. We share some premises with the Nottingham Building Society. So I'm sitting in Lincoln. We started in the Grantham, East Midlands area, and we sort of expanded out from the East Midlands. Some of you may be familiar with the sort of Belvoir connection. So we're nothing to do with Belvoir Castle. We used to manage the properties for Belvoir Castle, but they're two separate businesses. They're nothing to do with us, and we pronounce the business, so we pronounce it Belvoir, much to the distress of the Duke of Rutland many years ago. And so Belvoir is essentially a lettings business, a residential lettings business. It's underpinned by strong recurring revenue. So 90% of the revenue, for example, that flows through Belvoir offices is generated from residential lettings. When we closed our doors for a short period during lockdown, the first lockdown in 2020, Belvoir franchisees retained about 90% of their revenue, even with their doors closed. So that's how robust the recurring income element is. Across the whole business, we manage about 73,000 residential properties on behalf of landlords. Northwood and Belvoir are very similar. They represent the lion's share of our franchises, and both Northwood and Belvoir are residential lettings specialists. So 90% of the revenue in Northwood comes from residential lettings. Newton Fallowell is a very strong estate agency brand, very well thought of in the East Midlands, exactly the same as Lavelle, which operates in Lincolnshire, two very strong sales offices. And last year we sold around 12,500 properties across these brands, and we manage about 73,000 residential properties. We also are heavily involved in financial services, so we sell mortgages through this network on the screen, but we also arrange mortgages for a number of other institutions such as Nottingham Building Society. Last year we acquired their mortgage advisory business, and we write all of the mortgages that clients require through the Nottingham Building Society, and we have a number of other strategic partners, and we've got 243 of our own mortgage advisors, either employed or self-employed, depending on which part of the business they sit in. Okay, so I've already mentioned the revenue last year and profit before tax, so I won't dwell on that. Earnings per share last year 20.4p, and that's up 35% on the previous year. If you look back further over the last 5 years, EPS is up 260% over the last 5 years. Net debt is now sitting at 1.3 million. That's down 65% on the previous year. If we look back sort of about 2 years, we're net debt at that sort of 2 years ago, maybe at the beginning of 2020, was sort of 7 or 8 million. It's come down very rapidly over the last 2 years. A few operational highlights. So we've got 463 physical offices. 360 of those offices are property, as I said earlier, and around 100 are mortgage advisory offices. Across those offices, we've got 243 advisors. We've increased the number of advisors by 20% year on year, and in my mind, I think we'll sort of end the year with circa 300 plus advisors. You know, we've got very strong growth in that particular business. And if you look at our turnover, our complete revenue at around 30 million, if you cut it in half, about 50% of our revenue comes from financial services, and around 50% of our revenue comes from property-related services. And within those property-related services, half our turnover, about 25% of that half comes from estate agency, and 75% comes from residential lettings. So point being, although we're very good at estate agency, we sold 12,000 properties last year, it's still a relatively small part of our business. As I mentioned earlier, 72,900 managed properties, that was up 12% on the previous year. So even though a lot of the action in our market was in estate agency last year, we still very quietly grew our managed book of properties, because that's always been very important to investors, it's important to our franchisees, and it gives us that sort of strong underpinning of recurring revenue. A few of the sort of business models that we're, just to give you some examples, a few of the sort of projects that we're working on. Nicholas Humphreys is a franchise business that we bought last year. It was a network of 20 offices, 17 franchised and 3 corporate. We bought the business from a guy called Nick Humphreys. He's quite a big buy-to-let landlord, and as well as his buy-to-let business, he also owned a relatively small franchise business. So we bought that from Nick Humphreys. You can see the lettings to sales split if you can see the screen. So 87% of the revenue is recurring. The key difference between Humphreys and Belvoir and Northwood is that Humphreys is student lettings, and we are looking to grow the student lettings side of the business in the future. I've mentioned the partnership with Nottingham Building Society. One interesting part of the arrangement with NBS is that we have access to sell mortgage products to around 50,000 LISA savers. So this is brand new. This is something that was launched sort of at the end of last year, and it's just starting to gather momentum. So it's an exclusive arrangement whereby we write mortgages on behalf of NBS, and we've got exclusive access to their clients. That's just an example of the partnership. And then the Clark business that you can see, Mr. and Mrs. Clark, again, brand new. We completed on this deal. It's a small deal, but we intend to grow this business over the coming years, and it's a home run personal estate agency model, so it's lower cost entry. Across the rest of our branches, our franchised offices, the average turnover of an office is about £320,000 a year, but that's from a retail unit. We wanted a lower cost entry model, so if somebody wants to join but they haven't got the amount of money they need for a high street shop, which a lot of people haven't, they can now join us through this lower cost entry model. So brand new. Watch this space, and we'll sort of report back to you in of the progress in that in due course. So before we just a slide to wrap up, really, you know, why invest in Belvoir? Well, I mentioned the word franchise lots of times during the presentation, and anybody who's ever met me or listened to me present will know that I'm hugely passionate about franchising. It's such a fantastic business model if it's done well, whereby the franchisee gets to keep the majority of the income that they generate. They pay a small amount of income across to the franchisor, and done well, it works really well for both parties, but it has to be done well. And we're very experienced with franchising. It works for some big brands in the UK, for us, for Domino's, for McDonald's. Franchising is a business sector that is growing, and it now sort of employs around the population of Leicestershire. Actually, is sort of involved in franchising. It's 700,000 or 800,000 people in total, but it's a great sector and one that we're very passionate about. As I said earlier, 25 years of unbroken profit growth, which we're very pleased about. A stable management team. In fact, our management team makes me look like a junior with just 24 years experience when the average experience is 29 years across the management team. Behind Louise and myself, we have around 12, 13 operational directors who manage each part of our business. So the brands that were on the screen earlier in the presentation, each one of those has an MD and a support team within them, and the MDs report to me. So the business isn't reliant on myself and Louise. We do have a strong operational team behind us. We're highly cash generative, so 56% of our gross profit comes from the recurring lettings revenue. Financial services is a real success story for us. Excuse me. You can see that back in 2016, we generated 0.3 million of gross profit from financial services. That's now up to 3.8 million, and we're still on the journey of growing our FS business. We're not at the end of it. So with 250 advisors as of today, I suspect we'll sort of finish the year with 300 plus advisors. And over the last sort of 5 or 6 years, we've made 8 corporate acquisitions linked together with organic growth, and we've helped our franchisees to buy over 100 of their own competitors over the last sort of 5 to 6 years, the same period. So we're a driven, growing business in a sector that's very stable. And if anybody's got any questions about the general market, happy to answer those at the end. So I think, Chris, that's pretty much ready for some questions if you have any.
You have not mentioned what percentage on your income comes from insurance product sales. Additionally, what percentage of that is new business as opposed to an income stream from retained insurance products?
Do you want to go with that one, Louise, just in general? So I presume, it's hard to ask a question back, Chris, but it's, I presume, are we talking about sort of mortgage-related insurance products or property-related insurance products, or just it's hard to know, isn't it? Have you got any stats with you, Louise, that we can share?
No, I don't think so. No, the insurance products aren't a big part of, it's a big part of our revenue. We have some life protection products through the mortgages, but I don't have that split out from the overall mortgage numbers. Okay.
Moving on. Is there a conveyancing product amongst the services that you offer?
No.
It's not. And is that something you on the line?
Do you know, yeah, possibly, Chris, and that's something that there are a few areas that we're particularly interested in the future. Build to rent is one of them. We appointed a new director to our board who joined. We've had a board meeting today. It was his first board meeting. It's a guy called John Di Stefano. And if anybody's ever followed Telford Homes, it was a huge success story. John sort of built a business that moved over a 10-year period. He was the CEO of a business that grew from 3 million profit to around 40 million profit, and it was acquired by CBRE. He's a build-to-rent specialist. He joined our board, and it was his first board meeting today. So build-to-rent is something we're very interested in. Commercial property, possibly, in the future, is something that we have the network of offices that we could service a commercial property business. That's something that we are always seriously considering, but we've had other projects to do for now. I think conveyancing probably fits below those in terms of priorities, Chris, in that although conveyancing is connected to property, of course it is. It's the legal transactional element. It is a completely different sector compared with the sectors that we're currently successful in.
Okay. Next question. With more online estate agents jumping on the bandwagon, reducing margins, how will this affect the Belvoir business model?
Yeah, again, that's a good question. In that, I'll just correct just part of that, really. In that, online estate agents, although it appears as if they're jumping on the bandwagon, their market share fell back last year. So it's a misconception that online agents are taking a larger market share. So I read a report this morning, one of the best sort of market reports, and this is widely covered in the press, that online agents were representing about 10% of all UK transactions. That's now fallen back to around 7% last year, so it's fallen back. In amongst that 7%, there are now fewer players, so some of them have fallen by the wayside and gone to the wall, and you know, one or two of them are relatively dominant but not making any money ultimately at their current fee levels. So they're not having any impact on our business. They're certainly not having any impact whatsoever on the lettings business. You know, property management to us and to me is all about having people on the ground. We visit properties. If somebody's boiler breaks down, they may need us to visit the property to instigate a repair. You know, guttering gets full of leaves in October, and when everyone switches the heating on in October, you know, it's all hell breaks loose with 10% of boilers not firing up. You know, it's very much a hands-on job that requires boots on the ground in properties, and there's no amount of technology that will replace that element of the work.
Yeah, good point. Which, interestingly enough, moves me on to the next question. Well, with properties and with buy-to-let properties being scrutinised with the insulation costs, new boilers, asking us to cut back, asking us to do a lot more to save on energy for obvious reasons. How's that going to affect the business going forward?
Again, that's a good question, because there's something on the horizon called EPCC. So an EPCC, you know, is a concern for some landlords in that they're going to have to, as you rightly say, pay money to improve their properties. But I think, you know, the overriding comment is, and I say this with a smile, Chris, is kind of, you know, welcome to the world of property. Really, we're all going to have to spend. We'll all be forced, whether we like it or not, to spend money on our properties, and landlords are included in that. However, what we're seeing at the moment is we're seeing rents going up very aggressively across the country. So Rightmove and Zoopla are reporting rents up in most areas by 10 to 12% compared to 12 months ago. At the point of a reference on our properties, we're seeing rents going up by 8.6% at the point of a reference. So that's not being advertised as such. And I suspect that those increases will start to be pulled through into existing tenancies over the next 12 months. In March, Zoopla reported that demand for rental properties was 76% higher than their 3-year rolling average, and yet the number of properties being advertised was 15% less than their 3-year rolling average. So demand is very high. Supply is the same as it has been for the last 5 years. It hasn't increased because of government measures. So what I'm coming to, Chris, is that I think government will probably start to be quite careful with measures that increase costs for tenants. That's my overriding sort of personal view. But with or without government intervention, rents are going up because of a lack of new supply.
Okay, thank you.
Market share, but also, Chris, market share, by the way,
yes.
we represent less than 2% of our addressable market. So, I mean, there are 5 million rental properties across the UK, a touch more than that. Around half of them are with agents like us. More will join agents as the sector becomes more difficult to navigate, like it is now. And if we manage 70,000, we manage 70,000 out of a possible 2.5 million. So we've got plenty of the market still to go at.
Yeah, okay. Another question is, I think, did you mention you've got around 170 offices or 170 shops, as it were, currently? How do you tend to expand? Yeah, go on, sorry.
Sorry, Chris, 363 franchised ones, yeah. Okay.
And what is the strategy going forward? Are you erring towards more franchises?
You know, we're not actually that hung up about the footprint, because the franchised, we've got 360 offices. The average turnover of any one of those offices is 321,000 a year. So these are really successful. You know, these are small businesses. A lot of them are husband and wife teams or families that run them. And with a turnover of 321,000, that's a sustainable, good business from a retail unit. However, we've now got 8 single units turning over £1 million, with the highest at 1.5 million. And we've got quite a number of franchisees who have got 2 and 3 offices. And then amongst the people who've got 2 or 3 offices, we've got franchisees now approaching, we've got some franchisees, a little group of them, kind of approaching a turnover of 2 million across their collection of offices. So you can see that, you know, if we've got a smaller office, growing it into a much bigger office that turns over £1 million is just as good as having 2 or 3 more new offices. So we're not that hung up about the footprint, but we can see lots of growth from what we have built already. And we've spent many years building this network, so we want to make the most of it.
Absolutely. Someone's picked up on the recent dilution in the past year to shareholders was disappointing, but in your view, obviously necessary. Can you explain and justify going forward?
Yeah,
sure. Good question, Louise. Do you want to have a go at that one?
The dilution came about of the exercise of share options. So share options had been granted to staff, many of them back in 2014-15, and I guess it was just, you know, it materialised last year that quite a number of them were exercised. We don't have any at the moment that were exercisable before, I think, January next year. But it was just a period where quite a lot of the share options just did come through. I think when you look at how the business has grown, and as Dorian said, the last 8 years have been quite substantial, but look how the business has grown in that period. I don't think there'll be too many shareholders back then that will be upset at the growth that our management team delivered during that period compared to what is relatively small amount of dilution.
Do you know, just to add to that one as well, I mean, we've made great efforts over the last 3 years to engage really closely with retail investors. So we do a lot of these presentations. We always answer emails. We talk to people directly. You know, put a lot of effort into that. And it's interesting, Chris, that when we talk to institutions, we've never had an institution with an issue about over share options, because their view is that if you've got the right motivating factors in place, then actually the management team and the staff will all push the business ahead. And there are so many good examples of that. So we don't think we had a scheme that was a problem. It was a scheme that was there to motivate staff. They achieved their objectives, and then of course we met our obligations. So I don't see that as being disappointing in any way, shape or form, but most people are welcome to their views.
Now, of course,
I think the cohort of investors who actually like to see some of the, you know, options given to staff, so that they, you know, they are incentivized and rewarded and feel part of the business going forwards.
I seem to have lost my.
We've lost you.
There I am.
We can still hear you. You're back.
Okay, I don't know what happened there. I do apologise. Just one. We've got time for one final question. The future is obviously very unclear for many businesses with so much going on, which affects people's spending power. How do you see the bumps in the road, and how will you overcome them? Big question, that.
It is actually. Then it's a really good question. I think we've been doing this for a long time, Chris, and I think what generally the feedback, you know, from most people is that they've got to know us, they trust us. We've been doing this for a long time, and I remember you could actually have picked that question up, and I remember back at the beginning of sort of 2020, we had that question from, I think, pretty much every shareholder who had access to a keyboard at that time, sort of, you know, asked that question at the time, and they sort of watched us navigate through the sort of COVID issues, and we had a lot of one fund manager in a newspaper said that he sort of voted us as his #1 choice for how we navigated through the COVID sort of issues. Bear in mind that I've personally run the business through a property sales crash, and we listed on the back of that, so we did brilliantly. We did really well when the property sales market crashed, because we were fundamentally a lettings business, and we still are. So I think we actually faced probably, you know, some pretty severe sort of wider market, you know, crises in the wider market. And then looking forward, I think that although there is clearly an affordability squeeze, I personally think that people will continue to pay their mortgage, and I think they will continue to pay their rent unless they have absolutely no other option but not to pay. Because if you can't afford to pay your rent and you don't own the property that you're in, what's your alternative? There isn't anywhere else. So You know, there aren't any council houses. There are 1.5 million people waiting for social housing, so there isn't an option. And what happened during the COVID period, just to give you an example, I had investors say to me, well, surely, Dorian, with furlough and all the other problems, you know, maybe half of all tenants won't be able to pay their rent. Our arrears across the whole of our lettings book didn't get higher than 4% in the whole of 2020, just didn't get any higher. We insure against the risk of tenants not paying in many cases, but not. So we know some of the tenancies are insurance backed, but I think people will value the homes that they're in, and that's always been the case.
Okay, brilliant presentation. Thanks very much for answering all the questions. Good to see you, Louise. Good to see you. And we'll send the slide decks to everybody and upload the video onto the Shares website, and we'll obviously send it to you to upload onto the Belvoir website. Thanks again.
Fabulous, cheers. Thanks.